Greetings, members one and all of the Salivation Nation. The speculators have dumped gold, but the price has gone up anyway. Let's explore. Yes, this is just another example of the diversion between paper price and the physical metal price. In this case, gold especially, I think, is really showing its rock steady price points, especially in the physical markets. Premiums are up, but there's this divergence between spot price, futures price, and then the physical price. And the gold is holding its own here. And this article talks about this. This is from thestreet.com, their Mishtalk section here. And it talks about the price of gold versus futures here. We can see open interest has been down through May, and the price has gone up, save for, obviously, this time here in March where there was that big dip. Silver took an even bigger hit there, which is where we saw the price to gold ratio of silver to gold ratio go to above 126. So it talks here, judging from futures and alleged jewelry demand, the price of gold ought to be falling, but it isn't. Let's explore what's happening with the price of gold and why, says the author here. I wonder he should have added a few more O's in that explore if he was familiar with me, but it says that chart was a courtesy of bar chart. And he talks about it, his analysis here, the commitment of trade report categories here we can see. And they show some of these where speculators have dumped gold, but the price has gone up anyway. So large specs dump, 115,736 contracts. Commercials don't dump, but they're down 111,290 contracts. And small specs dump a lot, over 40,000. And managed money dump 125,000 plus contracts. Note that the commercials are down 111,290 since February. This is not covering shorts, as often claimed. Rather, it reflects speculators dumping contracts. So managed money dumped 125,456 contracts, yet the price of gold rose from $1,644.60 to $17,051 or $1,751.70. If you go back to 2010, we can see where the close was, and commitment of trade there is down, and that date was the open interest to today is quite similar. 284,561 contracts short in August of 2010 versus 274,322 today. The price of gold was then $1,249. The level of shorts has little to do with the price of gold, except as a measure of short-term price fluctuations. Normally, when speculators add contracts, the price of gold rises, and when speculators are liquidating contracts, the price falls. But not even this is happening now. I'm going to make a note here because I think this is where you get that little the water is muddy between speculators and manipulation. And speculators are exactly what they are. It's enterprises that have interest in the markets from one way or another, and they sell because they're speculating, and that's a manipulative action. Yes, indeed, I believe. So what about jewelry? It also, by the way, it's a manipulative action that is part of what I refer to as natural market forces. So what about jewelry? According to the World Gold Council, demand for gold jewelry in 2019 fell 6% overall to 2,107 tons. How did the price affect the gold? I can see there. The price of gold does not follow marginal jewelry usage either. It's pretty amazing that much gold is used for jewelry. So the subject of marginal utility of gold and jewelry came up in a Twitter discussion over the weekend. So Mish Shedlock, the author here, says jewelry is totally irrelevant to the price of gold. I tend to agree with that. because there's so much premiums over jewelry, especially most jewelry has insane premiums to it because there's so much that goes on. It seems to be so far removed from the spot price of anything because of those massive premiums. He says the supply of gold on his Twitter post here is nearly every ounce ever mined, curiously similar to Bitcoin. And then it talks about the supply of Bitcoin and gold leads to silly projections there, and it talks about Peter Schiff losing his Bitcoin password and wallet. It talks about intrinsic worth of Bitcoin there. And then he said he's covered the topic recently about Bitcoin. People confuse jewelry buying with the demand of gold and Bitcoin mining with the supply of Bitcoin. Contrary to the popular myth, the supply of Bitcoin goes up every day. This is why having the mining rate of Bitcoin did nothing for the price. Similarly, people confuse demand for new gold jewelry as the demand for gold. Charts like to perpetuate all kinds of silliness, such as this here. Jewelry demand over 52% there. Total bar and coin demand 25%. It's still an amazing number, but it does really make sense. I mean, jewelry, especially with nuptials, I mean, every married couple likely has either a 10, 14, or 18 karat gold ring. So yeah, it's crazy. And it does not represent the demand for gold. It says 52.54% of incremental usage was used in jewelry, so what? Did that set the price of gold or affect it at all? Then it talks about the misconception about gold. So the best explanation of the demand for gold comes from Peter Tenenbaum of the Acting Man blog. He was my teacher in Austrian economics. Tenenbaum wrote Misconceptions About Gold as a guest post in my blog from 2007 under the pseudonym Trotsky, a name he regrets. Gold was $650 at the time. Oh man, yes, and that wasn't that long ago. Can you imagine if gold was $650 today? Tell you what, something else. That tells you how far gold has come since then. Because I remember back in 2002, 2001, when gold was trading under $300, well under $300. And what really was this notion of, well, does gold really have much worth as a hedge against economic instability? It really didn't seem so at the time. Boy, today it's a completely different story. If gold's price was determined by a fabrication demand alone, jewelry and industrial uses, it could not possibly trade at a price of $650 an ounce. Notice he says this by fabrication demand. Many gold analysts from the mainstream to fringe groups such as the Gold Antitrust Action Committee claim they can predict what the gold price will do by adding up annual fabrication and investment demand as well as de-hedging demand by miners and contrasting the resulting total with annual supply, which includes mine, central bank selling, disinvestment, and scrap. In short, they analyze the gold market in the same manner as they would analyze the copper market. It should be immediately obvious that this can't be correct. After all, nearly the entire gold ever mined, approximately 150,000 to 160,000 tons, is still there. In short, the total potential supply of gold is some 97 to 98% greater than the gold produced every year, approximately 2,600 tons. So it's pretty amazing. Yes, indeed. So one can further illustrate gold's unique nature as money with a study of gold prices versus jewelry demand. If record fabrication demand for gold must be good for the price of gold, then a historic high in jewelry demand should in theory coincide with a high gold price. However, record high jewelry demand from 1999 to 2000 is in fact coincided with a 20-year bear market low in the gold price. The exact opposite of what traditional commodity supply and demand analysts would suggest. We can therefore conclude that there must be some source of gold demand that is far greater importance than jewelry or industrial demand components, and that demand constitutes the true driver of the price of gold in terms of fiat money. Indeed, there is. This demand component is called monetary demand. Very important here, folks, and I agree with him completely on this. because gold is money. Monetary demand and the supply of gold is actually best described as a degree of reluctance of the current owners of gold to part with their gold at current prices, since, as mentioned above, some 160,000 tons are owned by somebody already. And you know what? A lot of that certainly is, these central banks have been accumulating a lot of it. And in April last year, the central bank of central bank, the Bank of International Settlements, at their Basel III conference, noted gold as a tier 1 asset, putting it on par with regular currency and reserve currencies around the world for trade, for sure. Crucially important. By the way, I'll pause here and also say that some of this monetary demand is starting to finally reflect with silver as of late. This high demand for silver rounds, coins, and bars is unprecedented in what we're seeing, and that is starting to help reflect in the spot price for silver going up. In fact, let's pause for a moment and take a look at gold and silver, and these prices are reflecting tremendously here. Silver is well above $18 now, $18.36, and so it is starting to recapture some of the losses that we saw in recent months, kind of back to where it was before COVID started. However, it should be a lot higher, but I think the reason it isn't is because so much of what the speculators for gold prices are actually hold true for silver prices, as well more than half of it is strictly industrial use for silver, and many other things. A very small percentage really is demand for gold has a monetary application, and no central banks are storing silver as a tier 1 asset or any kind of asset because of the space it takes up. That does not mean silver is not money, and it does not mean it's not a hedge. It goes on here, continues along with jewelry usage for gold. Jewelry demand is about 500 tons or so out of the supply total now, up to 190,000 tons or so, minus some percentage lost or tied up in priceless art. Assume 20,000 tons of gold lost in art, or we can calculate new jewelry demand as 500 to 170,000, or 0.0029. The idea that jewelry has a meaningful impact on the price of gold is thus ridiculous. Unfortunately, the World Gold Council itself spreads jewelry nonsense as the demand for gold. Bloomberg, Wall Street Journal, and countless other perpetuate the myth, so it's no wonder people are confused. That's right. Gold is primarily a monetary asset, in my view. And I think for most of us, we would agree with that as well. And we look at gold versus the faith in central banks, and I think this is quite telling. Chart, screen grabbed from the Fed itself with these little different pointers. I think we're going to go through this because I think this gives us some idea. And you can basically take all this information, cut it in half, and apply it to silver. In other words, you can discount the weight of the argument about half, maybe for gold, because we have seen the gold to silver ratio pretty much be expanded doubly. So therefore, you can take about half of that away based off the current sentiment for silver. So on August 15th, 1971, Nixon closed the gold window. Gold was trading at $43.15 an ounce. Note that's slightly above the $42.2222 dollars that is on the books for the storage of gold at Fort Knox. January 22nd, 1980, gold closed at $850. That was the market top for decades. The Fred chart is monthly average, so peaks as shown incorrectly. The U.S. inflation peaked at 14.8% in March of 1980. The Fed, led by Paul Volcker, raised interest rates to a peak of 20% in June of 1981. The hikes convinced the public that the Fed had things under control, and then the price of gold went down. And then we see here in May 7th of 1999, after the Greenspan's great moderation, disinflation, slowing falling interest rates, little reservation demand for gold, the price was pretty much lackluster. Kind of where silver is, it's been kind of following that same path for quite a while. Kind of lackluster performance there. But on May 7th, 1999, The Bank of England announced plans to dump its gold for other assets. The price was $282. I think that was during the administration of Gordon Brown. Several people have been posting lately about Gordon Brown. His crucial mistakes selling while it's low. Bad news to do that by anybody for sure, especially if you're holding an asset to preserve your wealth like that. The advance notice drove down the price by 10%. The first auction was July 6, 1999. Gold bottomed at $252 on July 20th. I remember when it was that price. That's for sure. Yes, sir. This is called Brown's Bottom after Gordon Brown, then Chancellor of the Exchequer. I have no idea how to pronounce that word. I have no idea what that word is. Then we had the housing bubble of the mid-2000s. Yes, indeed. And then on August 23rd, and then the Great Recession, August 23rd, 2011, gold peaked at $1,923.70 with a European debt crisis and the Fed involved in quantitative easing. Then on July the 26th of the following year, European Central Bank President Mario Draghi made the famous whatever it takes speech. The ECB will do whatever it takes to save the euro, and believe me, it will be enough. Gold closed at 1614. Faith was temporarily restored. And then on December 17th, 2015, faith in central banks peaks. Gold closed at $1,050. Most of us remember that. And in fact, I remember that time people were saying gold is going to go below 1,000. I stood strong and said, I don't think it's going to go below 1,000. Fed talks of normalization, and then we have the QE4 repo panic, and it's been on fire ever since then. Crazy. The demand for gold is actually a reflection of the faith in central banks, and then we saw that great moderation we talk about from 850 to 250, and then whatever it takes speech there. And then we have the alleged gold shortage. The second widely perpetuated myth is that there is a shortage of gold. That's pretty funny given that there's roughly 190,000 tons of supply. The myth stems from short-term demand fluctuations for certain forms of gold, typically coins, resulting in the price spikes in that form, but not gold itself. Shills then come out of the woodwork and profess buy gold while you still can. Never give in to that kind of fear. Never, ever, ever. So another popular shortage argument pertains to futures. The futures battle cry is, if only everyone would take delivery, we would run out of gold, and the commercials would be ruined. The commercials would not be ruined, or they would have been ruined long ago. They were short the entire run from $250 to now. The commercials are either hedged, or they are producers who sell their production versus futures. Moreover, future speculators do not reflect a demand to own gold. They reflect a demand to rent gold with a leverage. I think that's important, and it's understanding the complexity of the markets. But nonetheless, we would not run out of gold if everybody took delivery, but the price would indeed rise. And I don't know about that. I just don't know. Now, this is showing kind of contrary to the prior video that we talked about, where they're doubly counting some of this glut from the New York, from the futures. I don't know that this is true either. We would not run out of gold if everybody took delivery, but we know, I think most everybody is safe to say that all the paper contracts out there, if everybody were to take delivery, there wouldn't be enough gold to cover. I think that's the one thing that I think most people are probably in agreement here, but this is kind of one of the first where he's saying it's not the case. If everybody took the gold delivery, we would not run out of gold. Maybe that means in practicality. In other words, if everybody took delivery, somebody's not going to come and take somebody's gold engagement ring. You know what I'm saying? It's not going to confiscate gold. So in that regard, yeah, you're not going to run out of gold in that way because gold is so dispersed. But anyways, gold is not the new unobtainium. Even the Wall Street Journal falls in the trap of perpetuating these myths. It's an interesting discussion for sure. And it's good to see that Mish is taking a contrarian point of view for many gold bugs out there. And I appreciate that. It's actually refreshing for sure, because just like with silver, we have to be realistic about gold as well too. But the overall report of the article stands that gold prices has gone up despite the speculators dumping. So there you have it. Post your thoughts below. Very interesting indeed. I'd like to extend a multitude of gratitude to you all for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.